It's 11:47 p.m. on a Sunday, you're sitting at your kitchen table with your laptop open, and you're doing the math again, not because you haven't done it before. You have at least a dozen times, but because something feels off and you can't quite name what it is. You bought the rental property 4 years ago. The tenant pays on time, the mortgage gets covered, the numbers more or less work. But you keep asking the same question. Is this actually doing anything for me? You scroll through the amortization schedule your lender emailed you in year 1. Page 3. And there it is. The thing nobody told you to look at. In your first year of payments, $9,200 went to interest. $2,100 went to principal. You paid $11,300 in total mortgage costs. You kept $2,100. Nothing went wrong. You're just looking at the wrong column. Here's the thing most first-time landlords don't see coming. The rental property doesn't start working for you in year 1. It doesn't even really start working in year 3. The math on a tenant-paid mortgage does something genuinely strange around the 10-year mark. And by the time most people notice it, they've either already sold the property or held it for entirely the wrong reasons. Anxious the whole time without ever understanding what was being quietly built on their behalf. If you've ever owned a rental property and wondered whether the juice is actually worth the squeeze, whether the repairs, the midnight calls, the vacancy months, and the spreadsheets are adding up to something real, subscribe and hit that like button, because that question is exactly what this video answers. My name is Elena, and I spend way too much time thinking about why the decade mark on a tenant-paid mortgage is the inflection point that quietly separates the investors who build genuine, lasting wealth from the ones who grind for 20 years, sell too early, and end up right back where they started. Before we get into it, not a financial advisor. This is not financial advice. These are the numbers, and what you do with them is entirely your business. Let's establish something first, because the mental model most landlords operate with is the wrong one, and it costs them more than any bad repair ever could. When most people evaluate a rental property, they evaluate cash flow. Monthly rent minus mortgage, minus taxes, minus insurance, maintenance, equals profit. That's the number they watch. That's the number they defend to their spouse, their accountant, their skeptical brother-in-law at every family gathering. If the cash flow is positive, they feel okay. If it dips negative after a water heater goes out, they panic and start researching what comparable properties are selling for. Cash flow matters, but it is not the most powerful number on a rental property held for 10 or more years. The number that actually changes your financial life is something almost no landlord tracks in the early years, because in the early years, it barely moves. It's called principal pay down. And what your tenant is doing to your balance sheet month after month, without you lifting a finger, is something you need to see on paper to believe. Most people who have owned rental properties for a decade are sitting on a wealth-building engine they have never properly examined and could not describe to you accurately if you asked them to right now. Let me show you the math. Then I want to introduce you to 2 investors who bought identical properties in the same year. One sold at year 7, the other held on. Where they each stand today is not a marginal difference. It is the difference between financial security and starting over. Let's use a real scenario. You buy a single-family rental home for $280,000. You put 20% down, $56,000 of your own money. You finance $224,000 at 7% on a 30-year fixed mortgage. Your monthly principal and interest payment is roughly $1,490. In month 1, here's how that $1,490 splits. $1,307 goes to interest. $183 goes to principal. Your tenant is paying your mortgage. Of that payment, they are handing $1,300 to the bank and $183 directly to your net worth. That is the deal in year 1. Now go to year 10. You are 120 payments in. Your outstanding balance has dropped from $224,000 to approximately $193,000. Over 10 years, your tenant has paid down $31,000 of your debt. Not you, not from your salary, not from a savings transfer. Your tenant walked into a lease, wrote a check on the first of every month, and handed you $31,000 in equity while you were going about your life. Sit with that. But this is where it gets genuinely interesting. This is the part almost nobody in personal finance takes the time to walk through clearly. And it's the part that changes everything. Here's where I need you to stay with me, because the second half of this video is where the math starts doing something I find genuinely hard to describe without just showing you the actual numbers. The principal paydown you just saw, $31,000 over 10 years, is not a straight line. It accelerates, and by year 10, that acceleration becomes impossible to ignore. What was a trickle at the start becomes a current you can feel, and if you sold before the current arrived, you will spend the rest of your investing life wondering what the property would have looked like if you'd simply held on. Years 1, 3, the invisible years. This is the phase where most landlords quietly second-guess themselves. Cash flow is thin or close to it. A repair comes up, the water heater goes, a tenant calls you on a Friday about a leak. You put in $600 and wonder, somewhere in the back of your mind, if this was a mistake. But look at what is happening underneath. Your tenant is paying $183 in principal in month 1, $185 in month 2, $187 in month 3. The numbers are small enough to feel meaningless. They are not meaningless. They are the foundation of a position that will compound across a decade into a six-figure equity event. The trap in the early years is the exhale. You handle a problem, things stabilize, the monthly numbers look acceptable, and you stop paying attention. You stop pulling the amortization schedule. You stop looking at the balance column. The problem is that inattention in years 1 through 3 is exactly when you walk away from the math that would show you why holding on is the entire point of the exercise. The one action for this stage: print your amortization schedule this week. Look only at the balance column, circle the year 10 balance, put it somewhere you will see it. Everything between now and that number is the work. Years 4, 6, the appreciation layer. Now let me introduce you to the two investors. James is 34. He bought a single-family rental in the same suburban market in the same year as his neighbor Priya. Both paid $280,000, both put 20% down, both placed tenants, same neighborhood, same property type. Their household incomes are close enough that salary cannot explain what is about to happen between them. By year 5, James is uneasy. A tenant moved out. 2 months of vacancy. Turnover costs. His accountant confirmed the annual cash flow was barely positive. James starts running numbers on selling. Priya had the same vacancy problem in year 4, 1 month empty, a few thousand in turnover costs. But she did something James hadn't done. She looked at her outstanding balance, $211,000. Her property had appreciated to $320,000. Her equity was $109,000. She refinanced, pulled $40,000 in cash, and deployed it as a down payment on a second rental. She held the first property. The trap in years 4 through 6 is treating a cash flow squeeze as a verdict on the investment. It is not a verdict. It is a test. The investors who fail the test sell. The investors who pass it begin to understand what they actually own. Years 7, 9, the shift. Here is the finding that rearranged everything when I first encountered it. Research published through the National Bureau of Economic Research has consistently found that residential real estate held for 10 or more years dramatically outperforms shorter holding periods, not primarily because of appreciation, but because of accumulated debt reduction combined with retained leverage. The mechanism is not market timing. It is simply the clock. By year 8, on that $224,000 loan at 7%, your monthly principal payment has climbed to nearly $280. You started at $183. That is a $97 per month increase in equity building. On the same fixed payment, funded entirely by your tenant, Your tenant's rent in year 8 is almost certainly higher than year 1. National average rent increases have historically run 3 to 4% annually. If you started at $1,700 per month, you are likely collecting $2,100 or more in year 8. Your mortgage payment has not changed, still $1,490. Your cash flow has expanded, and the share of each payment going to principal has grown every month without you doing anything differently. The villain in years 7 through 9 is not the market. The villain is the 7-year itch. The moment investors get impatient, get tempted by the visible number of a market offer, and exit exactly when the leverage is about to tip permanently in their favor. It is the single most common and most expensive decision in buy and hold real estate. Year 10, the tipping point. James sold at year 7. He netted $68,000 after agent commissions and partial capital gains exposure. He deposited it into a brokerage account. He felt relieved for about 18 months. Then he watched the market keep moving and did the math on what he had walked away from. Priya is in year 10. Her remaining balance, $193,000. Her property value, $340,000. Her equity, $147,000. Her tenant paid approximately $31,000 in principal over 10 years. Market appreciation contributed $60,000. Her original $56,000 down payment has grown into $147,000 in equity, a 162% return on original cash invested, without a single dollar of her own money touching the mortgage after closing. Let me say that again, $56,000 in, $147,000 in equity. She still owns the asset. And here is what James does not have: a property generating expanding monthly cash flow, a loan balance dropping faster every year, and a tenant who, if she holds for another 15 years, will effectively hand her the property free and clear. Here is what most landlords at year 7 through 10 don't realize. The reason this math works is not magic, it is amortization structure. Front-loaded interest means the bank collects its profit in your early years. By midpoint on the loan, the balance tilts. The bank gets less per payment, you get more. That is baked into the contract. The bank designed the system for its benefit. The investor who holds long enough eventually borrows that same system's momentum. The trap disguises itself as patience. It looks like you're merely holding on, merely maintaining, merely not losing ground. But holding a tenant-occupied, appreciating, amortizing property for a decade is one of the most effective wealth-building instruments available to an ordinary household. It just doesn't feel effective. That invisibility is the problem. You cannot feel $183 per month becoming $280 per month in principal reduction over 8 quiet years. You can feel a bad vacancy month. This is not your fault. Nobody teaches you to read the balance column. Banks prefer you focus on the payment column, the number they collect. Charlie Munger once said, "The big money is not in the buying and selling, but in the waiting." He was describing equities. He was also describing every landlord who ever turned a modest down payment into a paid-off property on someone else's income. There is no trophy for selling at year 7 and feeling liquid. The only scoreboard that actually matters is the one nobody else can see. Let's put it together in concrete terms. Meet the Okafor family. Combined household income, $118,000. Not wealthy, above median, but nobody who encounters them would think. Real estate investors. They drive practical cars. They watch their grocery budget. They bought a rental property in 2014 for $255,000, put $51,000 down, financed $204,000 at 4.5% for 30 years. The tenant has been mostly consistent. There were repairs, one difficult year, and one vacancy month. Entirely normal landlording experiences. Their current balance, $158,000. Their property's current estimated value, $390,000. Their equity, $232,000. Their original cash invested, $51,000. The tenant, Over 10 years, paid down $46,000 in principal. The market delivered the rest. The Okafors did not time anything. They bought a reasonable property in a stable neighborhood, placed a tenant, and held. These are not exceptional people doing exceptional things. They are ordinary people who never stopped looking at the balance column. That is the entire difference. There is a man most people in personal finance have heard mentioned, but few have really studied. His name was Ronald Reed, a gas station attendant and janitor from Vermont who died in 2014 and left an $8 million estate to his local library and hospital. He never earned a high salary. He wore a safety pin jacket to keep the cold out. He drove old cars. He bought stocks in real estate and held them for decades. He never sold anything he didn't have to. The lesson from Ronald Reed is not that you need to be a janitor with uncommon discipline. The lesson is that time in the asset beats nearly every other variable: salary, strategy, market timing. Reed had none of those advantages in any obvious form. What he had was the patience to hold things that were slowly, quietly, invisibly working in his favor. Rental properties held for a decade, with tenant-covered mortgages, are exactly that kind of asset. The math is on your side from the moment you close. Your job, the only job, is to not get in the way of it. You can choose not to play this game. Real estate is not for everyone. Landlording carries real costs: time, stress, unexpected repairs, the occasional tenant situation that tests your patience in ways a W-2 job never would. If that trade does not work for your life, the decision is entirely valid. But if you own a rental property right now, and you are thinking about selling because the cash flow isn't spectacular, or because you had one rough year, or because the market has run up and you want to lock in the gain, you need to look at the column that is almost never discussed in any of those conversations. What is your current equity position? What did your tenant pay down last year specifically? What will they pay down in the next 5 years if you simply hold on? Run those numbers before you decide, not after. 3 specific actions. This week, first, pull your most recent mortgage statement and find the principal portion of last month's payment. Write it down, then compare it to your year 1 amortization schedule. The increase in that number is the proof of concept. Second, divide your current equity by your original down payment. That is your return on cash invested. If it is above 150%, you are in the middle of a compounding event. Know exactly what you are walking away from before you sell. Third, if you are in years 5 through 9 and feeling the squeeze, run your balance to year 15 in any free amortization calculator before you make any decision. Look only at the balance column. What your tenant will hand you in 5 more years of patience may be the single most important financial number in your life right now. The gap between James at 45 and Priya at 45 did not open when James signed the sales contract. It opened in year 7, in one afternoon, where James looked at the wrong number, made the wrong call, and felt good about it for 18 months. The boring choice is not the consolation prize. It is the strategy. And for the investors who stay with it, year 10 is not just a milestone. It is the moment they realize the math was never working against them, it was working for them the entire time. Quietly, invisibly, on the first of every month, while they were busy wondering if it was enough. And if this video changed the way you look at your amortization schedule, if you pulled it up mid-video and felt something shift, that is exactly what the like button is for. It tells me to make more of this, and it puts this video in front of the landlord sitting at their kitchen table right now at 11:47 p.m., staring at the wrong column, about to make the wrong call. See you in the next one.